Good morning, everybody, and welcome to today's edition of the Anderson Tax webinar series. Today, we'll be looking at the impact of some recent regulatory development on businesses. Essentially, we're going to be looking at significant economic presence. Recently, the Minister of Finance issued an order with respect to that, subsequent to the Finance Act. And then we'll also look at the Cbn Circular restricting FOREX for imports through third parties. And also issued another circular clarifying their position on the first one. Now we'll start with significant economic presence. We'll just basically run through a background of the issues, how we arrived at where we are and where we were before. Prior to the enactment of the Finance Act, Section 13, as we all know, provided the basis for taxation of foreign companies that had businesses in Nigeria or that derive profit from Nigeria. Based on Section 13, for those non-resident companies to be subject to tax in Nigeria, they needed to have a physical presence, which in the Act was referred to a fixed base. However, the Finance Act then amended Section 13 and expanded the scope for taxation of non-resident companies by introducing the concept of significant economic presence. Further to that Finance Act, the Minister of Finance, Budget and National Planning issued the Companies Income Tax Significant Economic Presence Order 2020, which defined significant economic presence and also prescribed a threshold for application. Now, what the order also did was to constitute SCP in two broad categories. One is digital activity. So for companies who are engaged in digital activity, the Act then sort of provided that for you to be taxable in Nigeria, if a foreign company that derives gross revenue or income that is more than 25 million or its equivalent in any currency, so be it pounds, be it dollar, or whatever foreign currency that you're earning your revenue from streaming or downloading services of digital content, transmission of data collected about Nigerians users generated from users' digital activity, provision of goods or services directly or indirectly through a digital platform, or provision of intermediation services through digital platform that links suppliers and customers in Nigeria. You also have foreign companies that use a Nigerian domain name. So where you have .ng at the end of the domain name, or register a website address in Nigeria. It also covers foreign companies that have a purposeful and sustained interaction with persons in Nigeria by customizing its digital platform to target those kind of people here. The second category of activity is technical, professional, and consultancy services. So if you're a foreign company that is doing business relating to technical, professional, consultancy services, you will have SCP in Nigeria if you earn any income or receives payment from a person resident in Nigeria, a fixed base, or an agent of a foreign company. Now, the order then clarifies the technical services and says that it relates to any service of any specialized nature, including advertising services, training, or the provision of personnel. Now, it also goes ahead to say that, notwithstanding all that has been mentioned, a foreign company will not have SCP, that's significant economic presence, in relation to any payment made to an employee of the person making the payment, for teaching in relation to an educational institution, or by a foreign base of a Nigerian company. Now, for SCP, like I said, it did provide a threshold for you to be liable to Nigerian tax. And it has a low threshold, which is 25 million. These are one of the issues that we're going to be looking at today. The other issue that we'll also look at is the risk of double taxation, because you have a situation whereby those foreign companies may face a risk of being taxed in Nigeria while also being taxed in another jurisdiction. There's also the issue of no basis for taxation or administration. Now, the other does not it doesn't provide for the basis of taxation of those companies, neither does it provide for any profit allocation rule or mode of filing and remitting of taxes. There is also that risk of unilateral approach by the unilateral approach that Nigeria has taken. Now, the minister introduced the concept of SCP and the other provisions in the Finance Act and the other without broad consultation and domestic and foreign buying of stakeholders. We know how this can impact Nigeria. I mean, we're all very much familiar with the digital tax that France, tried to introduce and what the US, announced in retaliation. So these are the kind of issues that people are already beginning to raise. Now, the other issue that we'll be discussing today is the CBN foreign exchange restriction for imports through third parties. Recently, the CBN issued a circular with respect to this. So Form M is basically a mandatory statutory document to be completed and registered by all importers with authorized dealers at the time of placing orders for goods into Nigeria. Now, obviously, the collapse in oil prices coupled with the COVID-19 pandemic led to a decline in Nigerian economic activity. Of course, that also affected government revenue and foreign exchange reserves. So what the CBN has done is to sort of try to mitigate the drop in Forex by issuing a circular eliminating buying agents, basically companies that help other companies like manufacturing companies and any other third party from accessing Forex through Form M for Forex purchases. Now, the CBN then went ahead to issue a circular where it sort of clarified its position while, restating the earlier position, but basically then went ahead to provide some other conditions that a company would need to fulfill if it still wants to go ahead and use a third party for their imports. Now, what are the implications of this CBN directive? The initial directive was to ensure prudent use of scarce forex resources and also eliminate incidents of over invoices and transfer pricing. These were the reasons that the CBN gave. In addition to double handling charges and other avoidable costs that are ultimately passed to consumers. However, its latest directive provides guidance to importers opting to use a buying company, just like I said, with several conditions that you will need to fulfill. One of which is providing for certain compliance requirements for the buying company and also defining ultimate supplier of products as the direct party selling the goods, even if it's not the manufacturer or the internationally recognized buying company. It also states that it mandates importers to pay to only the beneficiary with the same name on Form M invoice or bill of exchange or letter of credit and other relevant documents. Now, obviously, this will have some transfer pricing implications, which is what CBN is saying that, look, they want to avoid, transfer pricing issues, but by doing this, it will also create some TP issues as well. And these are the issues that we're going to be discussing today. Now, joining me today to discuss these issues are two industry experts. We have an industry expert in the treasury function. We also have an industry expert in tax. So joining me today will be Sarah Akbala, who is an industry expert in treasury. And I will also be joined by Mrs. Bimbo Awosaya, who is an industry expert in tax. And of course, we will have Mr. Matthew Wondbola, who is the Director of Tax Policy in FRS. And I'll be joined by three of my colleagues, Dr. Josh Bamford, who is the Head of Transfer Pricing in Anderson Tax. He's a partner and Head of Transfer Pricing in Anderson Tax. I'll also be joined by Mr. Michael Ango, who is an Associate Director in Tax Advisory Unit of Anderson Tax. And then I'll be joined by Adeyemi Adediro, who's also an Associate Director in Anderson Tax. Welcome, gentlemen, to the discussion. Now, I'll go straight to, let me just stop sharing my screen, briefly. Now, I'll go straight to the panel conversation, and I will invite the panel to sort of give us a sense of what their own reaction is to, number one, the very first issue, which is the CBN. We're going to start with the CBN circular. Sarah, could you please give us your perspective or your reaction to that CBN circular?
Hello, everybody. Good morning. So, I mean, the circular, the one on the 24th of August was, very a shock, to the industry and those who are, real-time manufacturing and real sector. I mean, it was very cumbersome because considering the pandemic and the resultant effects on lines, I mean, to open letters of credit, to do trade, there are trade lines given, globally to Nigeria, which is funneled down to banks and then funneled down to manufacturers and other consumers. So as we know, Nigeria has a negative rating. So the risk of doing business with the Nigerian banks is very high. This has caused lines to shrink globally to the Nigerian banks. That's from the global banks for trade, to shrink to the Nigerian banks, meaning that Nigerian customers have to scramble. How the circular affects us is this way, based on what I've just said. Because we are dealing now no longer with our buying houses, no longer with people who would consolidate for you and sell. You have to deal directly with these manufacturers who you have no relationship with. And trade basically runs on trust. So if I know you and I've been doing business with you, my mode of payment will not be as expensive or will not be as difficult as if I do not know you. Trade is based on trust. Now, because most of the ultimate product suppliers or OEMs do not know the manufacturers in Nigeria because of the whole circular on the buying houses, they would all demand for letters of credit. Now, as I mentioned earlier, the lines for letters of credit have shrunk on account of the pandemic and Nigeria's negative rating and all that. So meaning that the manufacturers have to scramble now for these confirmed lines to be able to open your letters of credit, to even have your importation coming. This, of course, and again, we know that the global supply chain, everything is slowed down. There's a reduced pace in global supply chain. So now you have to scramble for lines because of the circular. Your cost of trade, your cost of transaction has to go up because letters of credit are the most expensive modes of payment in international trade. And most of the manufacturers, because of the trust level, because they do not know the Nigerian, and most of the ultimate product suppliers, because they do not know the Nigerian manufacturers, insist on confirmed letters of credit. So I would say my reaction to it is, is shock that the government is somewhat trying in their own ability and capacity to try to look out for the common man, but not considering the intricacies of the operational day-to-day costs that go into the trade process, which will invariably be passed on to the consumers. So I think it's the government is looking at it in one way and not looking at it holistically. So that's my reaction to it. However, they have brought out another circular to try to explain their position on define what ultimate product supplier is. So for the definition is good. However, as with the Nigerian, as with the CBN, you always have conflicting details on their documents. If you look at the circular, you'd see that there are at least 4 clauses. You'd see that from clause A to C for the new one, which defines what an ultimate product supplier is. You see that they have defined what ultimate supplier is and said from A to C, they are saying that the name of the beneficiary on the form, on the letter of credit, on the commercial invoice must be the same. And I assure you that 99.9% of existing transactions have that criteria met. So it's not it is not a wow moment, because it is what is existing. This is what exists already. Now they go further down and so clause D to say that, to ask for, to point out documentary requirements, and they said, oh, you're okay. If not, to where let me just read the exact wording. That where it is unavoidable that an importer chooses to use a buying company, the importer shall make available the following documents. So this statement conflicts with what we have in A to C. This has given room for all the banks to interpret the circular the way they have seen it. So you don't have a general, all the banks, all the DMBs in Nigeria saying, oh, this is what I want to do. Everyone has their own position on this circular and their own interpretation of it. So what it does in the industry is, people in the industry are at this point, still somewhat confused. But I mean, there's some form of relief. But most banks, I'll tell you, as of today, most banks are not readily accepting buying agents. You have maybe 4 to 7 banks generally accepting buying agents. Most of them are still insisting on writing to the CBN for clarification. So hopefully we see the CBN sheds more light on this issue, maybe in the following weeks. So I think the clarification they've done is as provided some relief to the people in the real sector. However, there's still some gray areas that has to be addressed by the CBN. That's my reaction on the circulars. Thank you.
Thank you so much, Sarah, for sharing so much light on that subject matter. Your practical perspective is very much is very enriching. Now I'll go to Bimbo, and the question now I have for Bimbo is that, I mean, do you think that the CBN directive is anti-business, and could it impact the ease of doing business in Nigeria? I mean, Sarah did mention some of the challenges that companies are already facing. The fact that you no longer have that opportunity to leverage on the kind of relationship that these buying agents have. So what would be your reaction? What would be your response to that? Do you think it's anti-business? And if it is, and how do you think it's going to impact, or do you think it's going to impact ease of doing business in Nigeria?
Thank you, Chiwendo, and big thanks to Anderson for providing this platform for us to discuss and review these pain points. To answer your question, in my honest opinion, the directive is not anti-business in its entirety. The directive was issued with an objective to ensure prudent use of foreign exchange, curb incidences of price manipulation, over invoicing, or profit shifting. However, I think the timing is wrong. An unexpected issuance of a directive with such significant effect on the economy negates the ease of business gospel that this government preaches. We would all agree that there's value in the multinationals leveraging their global procurement arrangements to meet import needs. An outright ban potentially increases procurement costs, which we all know would ultimately increase the cost of goods to the final consumers. With loads of outstanding obligations, already stretched trade lines with the banks due to obvious liquidity challenges, which already portrays Nigeria as a risky country, it's going to be very difficult for new suppliers to be willing to do business with Nigeria without securing their payments. So somehow this has, of course, resulted in delayed production and in some cases, complete shutdown of operations. So for example, if a company succeeds to negotiate with a new supplier, there's an additional cost, which will be that the company is either going to the parallel market to open cash-based letters of credit, or opting for confirmed credits, letters of credits from the bank, which comes at a higher rate. I think that's about LIBOR plus 10. And of course, this will have a huge impact on the bottom line of the company. One would expect that the CBN would have proactively considered the ripple effect of the directive prior to issuing same. But overall, I would say it's not totally anti-business. Thank you.
Thank you so much, Bimbo. Just staying with you as well, and I'm just trying to piggyback on what you said, and I think what Sarah also said. And we know that by that full-on circular, that the CBN provided or sent, where they provided clarification on the definition of ultimate supplier to include buying houses, and also give conditions, which is that they must furnish 7 one-off documents, and that must be approved by the CBN before banks are allowed to process the Form M. Now, just staying with you now, do you think people are able to furnish those kind of documents? I mean, my own, what I hear from people is that, I mean, those are documents that may be difficult for companies to furnish. But, from your own perspective, do you think those documents are easy to come up with?
Thank you, Shiwendo. Let me start by saying the follow-on circular is enveloped in some sort of ambiguity. There are varying interpretations by stakeholders, like Sarah mentioned earlier, and stakeholders here would mean the banks and companies as well. For example, Bank A intends to carry out an independent KYC process, while Bank B is happy to receive a duly completed form from the importing company. I mean, what exactly is the expectation of the CBN, right? And who bears the cost of this independent KYC, if in the real sense there should be an independent KYC? Speaking of the one-off documents, specifically evidence of tax payments in the home country, some questions come to mind. What happens where this buying house is a resident in a tax-free haven? I mean, it means that that company is not paying tax, whereas the CBN here wants to see evidence of tax payments. Another question is, what happens if there are no TP regulations in that country? Will this mean that Form M cannot be processed? I mean, those are the questions that need to be answered. I expect that it will be easy to obtain other documents like the financial statements, and all of that. I mean, and that's provided that the buying houses are not dummy corporations. And by dummy here, I mean fake companies. I'm sure you all understand what I'm talking about. Thank you.
Thank you so much, Bimbo, for that wonderful insight. So I'm going to go to Mr. Bondubola. And the question I have for Mr. Bondubola is, I want to find out whether, because obviously this CBN directive has transfer pricing implications. And my question is the FRS involved in this policy? And what are your thoughts around this policy, really? And if the FRS is involved?
Thank you very much, Chiwendu. And I think I will follow up from Bimbo's comments. The question you are looking at, I think we need to put this into perspective. What was the goal that CBN was pursuing in coming up with this sort of policy? It is to preserve our very scarce foreign exchange earnings, which had continued to dip on account of the crash in the oil prices, our ability to produce oil itself, which is compromised due to many other factors, and of course the COVID challenges that had curtailed productivity and ability of Nigeria to earn non-oil exports, foreign exchange. Now, as to the involvement of the FRS in this policy, we must also understand that the roles of the organizations are different. The CBN is in charge of monetary policies, while FRS implements the fiscal policies. I agree that there are linkages between the fiscal and the monetary policies. That is true. But when an issue is strictly a monetary issue, it is within the scope of the CBN to work on that. And when it is an issue having to do with fiscal issues, then it is within the Federal Ministry of Finance and the FOREX to work it out. Howbeit, if there are issues that cut across, then it will be important that all agencies, whether within the monetary or the fiscal space, come together to work out. Now, as to whether this is going to have impacts on transfer pricing, I don't think so, and I do not expect so. Why is because whatever measures the CBN had put in place is for the purposes of managing foreign exchange earnings of Nigeria, for the purposes of remittances and all of that. Whereas transfer pricing is a global standard for dealing with controlled transactions, that is transactions between connected persons, for the purposes of determining the appropriate amount of taxes to be paid. So the two are not exactly the same. Yeah, there may be some areas of friction, but in my view, they are not significant enough to affect either the monetary policy or the fiscal policy or tax payment. I think this will be my initial reaction to that your question. Thank you.
Thank you so much, Mr. Bondubola. I'd like to hear from Dr. Josh. His take on the recent move by CBN to limit buying houses access to secondary market. Mr. Bondubola already said that it doesn't have any transfer pricing implication, but I'd like to hear from Dr. Josh. Dr. Josh.
All right. Thank you very much, Chimwedu, and thanks to all the other panelists and organizers of this event. I think before I talk about the current circular, the follow-up circular, I need to dial back a little bit and try to agree with Mr. Bondubola in terms of the fact that the objectives that CBN is trying to achieve is clearly different from the objective that transfer pricing tries to achieve. But where I will differ a little bit is that the source of the problem are pretty similar in terms of the nature of the transaction they are trying to deal with, so that the solution may require some transfer pricing element, hence the requirement for a transfer pricing policy. So what do I mean by that? So first and foremost, let's understand the reason why CBN came up with this particular circular. So we all know that there's been a significant shortage of Forex in the market, because our major foreign exchange earner, which is the export of crude oil, has suffered due to the pandemic, and the follow-on in terms of less demand for crude oil in the global market. So because of that, the supply of Forex into the market to meet the demand, all right, the supply is way lower, creating a shortage. So one of the options that CBN has then taken is how do we then curtail demand so that we don't have excess demand of Forex in a market where there's a shortage in the supply of Forex. Now, one of those initiatives that they've come up with is to recognize that a significant number of companies in Nigeria import products from offshore, and they have to pay in foreign exchange, which also leads to this increase in demand for Forex. Now, they believe that if these companies were to buy directly from the primary manufacturer and skip multiple layers of a supply chain, then hopefully, the price at which that particular product, is sold to the Nigerian entity, will be lower, and therefore the demand will not be as much. So in their view, by curtailing the number of phases in the supply chain, they'll be able to reduce this excess demand of the product. Hence the first circular. So in that circular, they defined what, and they mentioned what is called an ultimate supplier, and also mentioned what are buying companies or agents. What they didn't do in the first circular was to define specifically what they meant by ultimate supplier. So it led to different interpretations by the banks. Some define ultimate supplier to mean the primary manufacturer of a product, like an OEM, original equipment manufacturer. And that created a lot of problems, and that led to some adverse distortions in businesses, because depending on your industry, sometimes you cannot even buy from the original equipment manufacturer or the primary manufacturer. Take the downstream. Many businesses might not be able to buy directly from the refineries in the global market. There are trading companies that are actual intermediaries who sell to the final buyers in the market. So if we take it from that perspective, it's practically impossible to buy from a primary manufacturer in that industry. You go to other industries, you face similar situation. A situation would be a case whereby the original equipment manufacturer might have a threshold, a particular minimum amount of volume demand. If you don't meet that, you cannot deal with the OEM. You have to go through an intermediary. So there are business reasons why you have to buy from an intermediary as opposed to a primary manufacturer. And so the first circular created that confusion. And there was a lot of response from businesses, from industrial organizations such as NECA, from tax advisory firms such as Anderson, where we came up with a publication, The Business Day. And thank God, CBN listened to all these comments and all these input, hence this positive reaction with the follow-on in terms of the circular. It then begs the question whether this new circular has resolved all the issues. Now, let me quickly wrap up on the positives of this new circular and the challenges. So the positive of this new circular is now they've defined what they meant by ultimate supplier. And ultimate supplier is not limited to primary manufacturer based on the follow-on. So we have a primary manufacturer as well as other buying companies or agents. However, if you're a buying company or agent, there are some conditions that needs to be met, all right, that will make them comfortable so that they can approve, for the local entity to prepare Form M to then transact with that buying company or agent, which is not the same if you're buying from the primary manufacturer. What it then suggests from CBN's point of view is that they are more comfortable if you buy from a primary manufacturer because there wouldn't be multiple layers within the supply chain, and therefore there might not be over invoicing. But whenever we are buying from an intermediary, we want to be comfortable that the price is not overinflated so that it doesn't put excess demand on the Forex locally. Now, for me, the bigger distinction is not really the primary or the intermediary, all right? The bigger distinction is whether you are dealing with a related party or not. Because if you follow the transfer pricing principle, if a local entity is in business to maximize profits, and he or she decides to buy from an intermediary, it's because that is the realistic alternative available to him in order to maximize his profit, because he's not related to that intermediary. If I can go directly to a primary manufacturer and I'll get a lower price, and I'm not related to both the intermediary and the primary manufacturer, why wouldn't I go to a primary manufacturer? Because I would want to have the cost as low as possible so I can maximize my profit. So the issue I think that CBN should be focusing on is when they do buy from related parties. Because even if I buy from a related party and that related party is the primary manufacturer, there could still be an incentive to over invoice if there's a different rationale, such as corporate tax rate in the location of the primary manufacturer is way lower than that of Nigeria. So it's not more about the stage of the supply chain. It's more about whether you have a related party and that transaction is controlled and can be subject to manipulation. So I think that their emphasis on the distinction between primary and intermediary, although there's some good logical basis for it, that is not where the risk actually lies. The risk actually lies where they buy from a related party intermediary or a related party primary manufacturer, because that's where they can pollute and manipulate and over invoice and therefore put undue pressure on the Forex. So asking for a transfer pricing policy can only be asked when you are dealing with a related party. If I'm an independent party, there's no need for a transfer pricing policy because there's no transfer pricing issue. Transfer pricing only comes up when you are dealing with a related party, not an independent party. Because when you're dealing with an independent party, it's already assumed that the transaction is at the market price, it's at arm's length. So really, there's no point for you to be concerned in that case. You have to be concerned when you're dealing with a related party, because that's where there's a possibility of pollution to manipulate the price in order to shape profit or lead to excess demand on Forex locally. So I think there's some misplaced focus for now because there's no clarity in terms of where the risk actually lies. But I have to agree that the second circular has made some distinction between what is really the ultimate supplier, and it includes a primary manufacturer as well as intermediaries. And that's a good first step. But I think that their focus should actually be on controlled transactions, which is with related parties.
Thank you so much, Dr. George. I think you've shed a lot of light. It looks to me, just like you did say, that the CBN actually is missing the point where they should be focusing, because preventing companies from using buying houses actually then create that transfer pricing issues, because they would then have to rely on their related parties offshore to make those purchases. I don't know whether Michael Ango has something to add to this in terms of Cbn Circular on buying houses from accessing forex. Do you have something to share with us, Michael?
Well, if Mr. Bonjibola and Dr. Josh have made some comments, I don't know what you want me to add. I don't think I have much to add to them, but I'll just address something that Abimbola said. She said she didn't think that the circular was anti-business in that sense. Yes, I don't think it was anti-business, but I would also say that it was probably not pro-business. So it's not something that would have easily enhanced trade. I think for me, whenever you see regulatory action, I think you always have to ask yourself, what is the motivating reason for the regulatory action? And then what is the end goal? So if the challenge is actually forex shortage, I do not think that the ultimate solution to forex shortage is to restrict access to it. Dr. Josh can tell us more. I think in basic economics, what you then try to do is you increase supply to match up with demand. Otherwise, what will then happen is that we'll then have to continue having to put new rules and regulations in place to ensure that we minimize access to forex. So to that extent, for me, I think at best you can say that the circular is a short-term action. It's not something that will ultimately address the basic challenge of forex scarcity or availability in the Nigerian economy. But more importantly, and I think this is also a lesson for our regulators, there's always need for proper consultation. You don't wake up on with such a momentous or very significant circular that has significant implications for businesses. So if I've opened an LC already, I owe someone, and then I was expected to get my allocation the week next to that, and then ultimately there's this circular which changes the entire color of what we're doing. But more importantly, there's a point that I'm not sure we've really looked at. So in the revised circular, what they've said is you need to get the financial statements, you need to get tax returns, you need to get some other things. I've spoken with someone who buys a lot of raw materials offshore, and the person dismissed it. You are coming to buy something from me, and you are asking me to provide you my documents for KYC, and I'm saying I'm busy. You're not. Excuse me. I have suppliers from 57. I have people from 57 countries who I'm supplying, and then you want me to suspend all I'm doing to start providing my financial statements, my tax returns to you because you are from Nigeria, and your CBN is not going to give you forex until you provide this. Okay, I'm sorry, gentlemen. Let me finish with the other guys. When I'm done with them, I'll come back to you. Maybe in another 6 to 9 months, I'll come back to you. So I'm saying that, look, in terms of the KYC, again, I'm not sure if it's a well thought out provision. Maybe we need to go back and look at it. Like Josh has said, if persons are buying from third parties, unrelated third parties, I think there is some assurance that the transaction will be at arm's length. Where the real focus should be is where you are buying from a related party. Then it is easier to manage, and then of course you can then ask for all of that. And then this is also where I'll address a bit of what Mr. Bonjibola has said. I think that FIRS too should probably want to get involved on the conversation, because if FIRS has a very strong transfer pricing unit, they have they are skilled and they're capable in that regard, then maybe what the CBN should be saying is that FIRS should certify or give some form of assurance, or rather you can have a review, you can have a biannual or annual review of transactions to confirm that, okay, these transactions within this entity satisfy arm's length rule and all of that, instead of saying per transaction, which will then slow down things and all of that. So I think that's my comment to that extent on the issue of the from M Circular.
Thank you so much, Michael. I'm going to go back to Sarah, briefly. And the question I have for Sarah is, I mean, being an industry expert and basically feeling the pain of this circular, what would you say would be your advice to CBN in terms of what they should have done, in trying to curb the FOREX pressure? So, because we all know the intention of the circular, but maybe it hasn't been pursued in the right manner. So my question is, what do you think the CBN should have done?
Okay, I think that's a loaded question, in that advising the CBN is to tell them to go back to the blueprint of the economy at large. As we know, we try to diversify, make more dollar, because the real problem we are facing as a country is the shortage of FX, to support international trade. So we need to go back to help the exporters, to find incentives to help the exporters. As we know, there has been a border closure as well. As for people in the industry, you will not believe it that there is no more land exports. There's no more exports, but we are only doing export via sea. And for many of the exporters, that they export in smaller quantities. So we have to all come together to see if we can take a container, take 2 containers, that type of thing. When we would, for neighboring African countries, we would just go through via land and export to other West African countries. So exports via land has been halted. We are having to go by sea, and most of these West African countries, we have to, some of them might be landlocked, so it's a longer route. It takes a longer time to ship to the neighboring West African countries. So I'll advise them, we have to go back to the drawing board. That's on a holistic, level, to try to build up and shore up our FX reserve. However, on the import side, I'll say that the government should engage stakeholders more and be more abreast of, global international trade globally. Having a buying house is not bad. It's not a bad thing, and as many people have mentioned. And even having our FX manual, there's something that talks about buying commission and all that. If you want to, be strict on buying houses, go back to what you have. You have the regulation in place for commission, for buying commission. You have a range of the percentage you should charge. So you can go back and enforce laws to say, okay, I want to see clearly. They've done something with price mechanism, the price verification mechanism, which is good. You can go a step further to use your existing laws, which you have in your FX manual, for buying commissions, to say we want to clearly see what you spell out what the buying houses commission are, because you already have this law existing, so you just have to enforce it. So that's that. And then for the price mechanism, the verification system, we see from the industry, what we see from the list that CBN has released, we see that the prices are not realistic. So they say, okay, for 1 ton of this, for 1 ton of refined sugar, bring in this, they give you a range of what you should do. Meanwhile, the prices globally are changing for commodities, equipment, and all that. So they need to just engage stakeholders real time. There has to be a real-time price mechanism. You can't just issue out a list to say, okay, I want it to be at $20 when globally the rate is $200. We all know that prices don't stay, they are not, fixed. So I think it's what my advice to CBN would be: look inward, see what you have, laws you have, try to work with what you have. Try to engage with other stakeholders to get the true picture of global happenings, so that you don't frustrate people and, as Member mentioned, close operations, delay the supply chain channel, because invariably your consumers you try to protect would suffer for it. Thank you.
Thank you so much, Sarah. I'm going to go to Mr. Bonbola. I think just one last question on this subject matter. And I know Dr. Josh has talked about where the transfer pricing issue really exists, and I think Michael also echoed that. But notwithstanding, CBN went ahead, with the circular. And my question is, do you find a nexus between the CBN's circular potentially relegating the traditional use of arm's length principle to protect tax base and the recent global agreement against arm's length principle, precisely the BEPS 2.0 Pillar 1 and 2? And if you think they are, we would like to hear your thoughts on this issue.
Thanks very much. I think maybe let me start from Josh. I clearly understand the perspective from where Josh is speaking from. Howbeit, we just must be very clear as we properly dissect issues. Like I said earlier, CBN has no role in taxation, as it were, whether in formulating policies or administering tax policies. Howbeit, its clear role and mandate has to do with monetary issue, including management of the foreign exchange. Now, the rules that the CBN had brought out is strictly for the purposes of remittances, strictly for the purposes of people making payments on their Form M or Form A or whatever transfer of funds from the Nigerian external reserve for the purposes of payment for goods and services. Now, if it has requested for example, transfer pricing policy, I'm not going to question the competence of the officers of the CBN to work with such documents. But I believe they are working with that kind of a document will be from the point of view of somebody making remittance, not somebody computing what tax is due. Now, as to the issue of the eliminating the layers of intermediaries between suppliers and the ultimate buyer, I know that there could be transfer pricing issues where those entities are related persons. But we also know that practically there have been a lot of schemes where entities that even though belonging to the same persons are portrayed as being distinct from those persons, from those groups, and that there are a lot of practical issues there. I mean, we can't deny it. What people can do in order to run away with murder. In as much as I'm not justifying what the CBN had done in any way, because I can't speak for the CBN, but I also know that as long as they are within the law that set them up and they are doing what they're supposed to do, I don't see any issue here. Now, as to whether now there is going to be a nexus or an handshake between what the CBN is doing and transfer pricing. First of all, we must understand that as we have it today, particularly in Nigeria, transfer pricing is based on the arm's length principle. Maybe tomorrow there may be changes to the rules. And the arm's length principle is a global principle. So it's not different from Nigeria, what happens in Ghana or what happens in UK or Russia or anywhere, as long as we are all dealing under the arm's length principle. And so if the CBN then have come up with some measures, it's still going to come under the same purview. It's going to come again on the theater table of the transfer pricing to begin to dissect. Are there connections, are there relationship between the entities that are dealing? Are the transactions controlled or uncontrolled transactions? All the various justification under transfer pricing are going to come in, all the questions. Do we really have a transaction, or do we have some internal transfers of values, and all of that? Are services performed? And before we even begin to say, let's benchmark whether the prices are what is due at arm's length. So all of these are tax issues. I don't see the CBN working in those complex and intricate tax matters. But like I said, for the purposes of administering the foreign exchange and payment and all of that, they could come up with as much rule as they believe is going to help them. And talking about the two organizations, that is FOREX and CBN talking together, I agree absolutely with the point that has been raised, because after all, both organizations belong to the same government, and we also have the same sort of customer base, because the bank customers are also taxpayers, and therefore we should then be able to do things in a way that will make their work and their operations and business a lot easier. Yes, to that extent, I do agree. But as to whether there is any fear or any concern that the CBN measures will have any impact on the ability of the FOREX to do transfer pricing, my answer is no. Thank you.
Thank you so much. And you would agree with me that we've sort of discussed this issue exhaustively. And I'm sure the participants will have some questions, and the conversation will still continue when we get to the Q&A section. So we're going to be moving on to the second subject matter, which is the issue on significant economic presence, and the order that was issued by the Minister of Finance. And I'm going to start with Mr. Bonjibola. We're going to stay with you here and start that conversation. And my question to you is to sort of could you run us through the global development that led to the introduction of the SCP order? I'm sure, given your experience, and especially coming from the transfer pricing, which I think is where this whole issue stems from, could you just run us through how we arrived at where we are now? I think you're on mute, Mr. Bonjibola.
Yes, I just realized that. Forgive me, these things do happen. Yes, thanks very much, Chiwendu, for that. I think we can take one or two steps back to where all of this started from. I believe this started as far back as 2013. I mean, in concrete terms, it started actually much further than that, but it started in 2013 when the G20 started the BEPS project. And one of the actions, and that's BEPS action number 2, was the tax challenges of the digitalized economy. And this had been an issue that had been with us for some time. And that is because before now, businesses are done basically based on physical presence. That's when we talk about the brick and mortar businesses. Before you can come and do something, you need to set up a physical office. And this was why in Article 5 of the various model tax conventions, when we talk about permanent establishment, they are always talking about having a fixed place of business, fixed in terms of physical location, fixed in terms of length of time. So that was how we used to do business. But then technology had helped us, that it now became possible to do certain things remotely. For example, in the FOREX, we recently launched the common transmission service for the common reporting standard. And the vendor that supplied the software did not set foot on Nigeria soil at all. I mean, from where they were able to log on to our database, they were able to log on to our system, they were able to upload the software, they were able to activate, and everything. They never came, not for once. Before, that was not possible. They would have had to travel maybe once or twice to be able to achieve that to Nigeria. And so because of that, the question then arose, when people do businesses remotely with another jurisdiction, how should the profits be taxed? What should be the sharing, the tax rights of each of the jurisdictions that are involved? So that is where the discussion started from. But unfortunately, the BEPS project could not address BEPS action number 2. And so what happened was to just provide a sort of background report because there was no agreement. And to that extent, in 2016-17, a new project was launched to now agree as to how the taxing rights in respect of such businesses that are done remotely are going to be shared. And that led to the issue of Pillar 1 of the current program that is running under the G20. Now, but again, we also discovered that that project itself is running very, very late. And that is because finding a consensus where we have 139 countries together agreeing on an issue becomes very difficult. And so what then happened is most countries who believe that they have something significant to gain from this project decided to be introducing measures, interim measures, as it were. And I mean, France, Germany, UK, India, you can mention them, have all had to put a lot of things in place. And recently, South Africa and Kenya have also done something. And so this is the background. This is how we came about in Nigeria to say, all right, we shouldn't begin to start out when the train has left the station. Let's start. And the way we wanted to do it is to do it in such a way that we do not jeopardize the discussions that are going on at the inclusive framework of which Nigeria is a member. And that's how we came up with the significant economic presence provisions introduced by the Finance Act 2019. And that's why you also find that we have put a proviso there that when the work at the inclusive framework, even though we didn't mention that specifically in the law, is done and is agreeable to Nigeria, then there will be there's a sunset on that provision in our law, particularly for entities that are coming from countries that are members of the inclusive framework who have also signed up to implement whatever regime is coming. So this is the background to this, and that's what has led us to where we are. And when you look at what we have done by way of the significant economic presence order that was released by the minister, is to provide further clarification as to what businesses we are looking at, what qualifies that business, and essentially how the taxes will be administered in respect of the entities that qualify or that come under the scope of that SEP order. I don't know whether I'm able to answer your questions in all, but those are the background that I can give you. Thank you.
Thank you so much. Of course, you've mentioned a whole lot that sort of addresses that question. I know Dr. Josh has done, I mean, he's very much conversant with what you just mentioned in terms of the issue that led to this. So I don't know whether Josh has something to add to what Mr. Bonbola just said.
Thanks, Chinwendu. I mean, when it comes to what is happening with regards to BEPS, there's no better source for you to get this type of information than our own Mr. Gojubola, because he's actually been on the table. They've worked on it. He's represented Nigeria as part of the inclusive framework. So whenever he's giving this information, we are getting from the primary source. We, the consultants, these are the few cases whereby we'll be getting our information from a secondary source. So for this, we really need to defer to him significantly. But I fully agree with all that he said. The truth of the matter is, even prior to G20 taking this initiative to ask OECD to actually update, the guidance on international taxation to make it consistent with current realities, because it had become outdated. We need to recognize what drove that decision. It actually came from the financial crisis of 2008, 2009. That financial crisis meant that most of these advanced economies entered into a recession. For you to stimulate your economy, one way to do that is to use fiscal policy. Now, the other way is monetary policy, but monetary policy had become constrained. In fact, if you look at most advanced economies, interest rates are near zero. And one of the monetary policy tools that you can use to stimulate an economy is to reduce interest rates so that you reduce cost of borrowing. Then businesses borrow more, and then investment goes up and it spurs the economy. So if your monetary policy tools are constrained, then really countries have to focus on fiscal policy. That is tax revenue and how you spend it. You understand, government expenditure. But they recognize a problem that if each of the countries aggressively start implementing their own tax laws in order to increase tax revenue, then who is going to suffer when two elephants are fighting? is the ground, that grass that will suffer. That's the multinational enterprises. Hence, the recognition that if multinational enterprises suffer, it's going to have a boomerang effect on those economies, because what you are trying to solve is actually boost the economy. But the economy is going to be boosted by these companies. So if you had them in the short and medium to long term, then you've not achieved much. Hence, they needed to then designate OECD to then come up with this framework, one of such being the digital economy. So I fully agree with the details that Mr. Bodibola has given in terms of where they've gone into. What I will add to it is this. It's not been easy for them to come to a consensus in terms of the approach of determining how each country that is benefiting from the digital economy, could be e-commerce. You can take, for example, Netflix, or it could be Facebook, or it could be Amazon. How do we actually determine the taxable profits for each of the jurisdictions where that company is benefiting in terms of sales or what have you? And that challenge has been very enormous. That said, there's been significant progress. There's been a recent publication coming from OECD, which has given a blueprint to the implementation of Pillar 1 as well as Pillar 2. What that blueprint suggests that internally, when you look at the technical work that has been done by the Inclusive Framework as well as the OECD Secretariat, there's been advancement. Now, the public, stakeholders like us, are supposed to then provide our input. Anderson Tax is working on that to provide input. But what it tells us is that sooner or later, their target is that by the end of 2020, there's some clear guidance and some consensus building by all stakeholders that this is the way to go. So it's a good thing that Nigeria has decided to come up with some guidance on significant economic presence, because they can't keep waiting until OECD comes with their position. So they've started, and it's also a good thing that they've given themselves a room that should OECD come with something that is acceptable to them, that would trump this temporary provision. So I fully agree with the explanation that Mr. Bodibola has made. What we need to be mindful as taxpayers and tax consultants is that it's subject to OECD coming up with something that is globally acceptable, so that we have consistency in the application of this concept in the digital economy across countries.
Josh, especially with respect to the light you just threw on the Pillar 1 blueprint recently issued by OECD. So I'll go to Mr. Adeyemi, and my question then is, of course, the whole SEP presents a lot of issues for companies in terms of implementation and all that. My question is, what do you think are the bottlenecks that companies will face in terms of implementation, or even that the government is going to face with respect to implementing the SEP order?
Yeah, thanks, Chiwendu, for that question. I mean, the first thing that jumped at me when I looked at the SEP order was to see the discrepancy between the commencement date and the date it was issued. It was issued on May 29. The commencement date is 3rd of February 2020. So the question is, you already have agreements, you already have even non-resident company providing services, between 3rd of February and May 29. The question is, what would they do in terms of, aligning with the provisions of the significant economic presence order, and mitigating the taxes that come to it. Now, those are areas that have not been clarified, And the second thing again is to look at the threshold. The threshold of 25 million, right? Compared to a country like Zimbabwe, that the threshold is about 500,000 USD. Our threshold is about 60,000 USD. If you compare that, that poses some kind of administrative challenge. It means that almost all and every non-resident company that has anything to do with respect to the scope that the SCP covers will be liable to tax in Nigeria. Then you then begin to ask yourself if the FRS has all the administrative tools and the wherewithal to go after each and every one of these. Yeah, I'm aware that the proposed finance bill empowers the FRS, to engage an agency to use some digital platform to track this income and then collect taxes. But the order is already in force now, and this is coming later in the day. How traction will be gained, in enforcing that these taxes are collected is yet to be seen. If you look at the order again, you look at how the Nigerian government seeks to tax these non-resident by aggregating the income, in arriving at the threshold that will trigger tax in Nigeria. So there's a definition of connected persons, which includes associates as defined in CAMA. If you look at CAMA, there's no clear definition of associates, So that's an area of inconsistency that needs to be clarified. And then you then go down and see that further definition of connected persons only speaks to controls, common controls and management control as well. And then that seems to be so limited when you compare to the amendment made by the Finance Act previously on what connected persons should be. And if you look at CITA actually tries to align the definition of connected persons to be consistent with the provisions in the transfer pricing regulations. So given this disparity, I would say that, if there are questions to what connected persons should be in arriving at the aggregate income that has been earned in Nigeria for tax purposes, then the provisions of the CITA should be the one to make reference to. So I would say there are also other concerns, the double taxation concerns. If I'm earning revenue in Nigeria and I'm liable to tax in Nigeria, and I'm also liable to in my own country, where there's no double taxation treaty between Nigeria and that country, it doesn't make business viable for me, and I begin to look at other countries, to actually move my business to. So we need to remain competitive. And I'm not sure how this significant economic presence seeks to address that. So for some companies that have been having concerns with how the DTT and impacts the significant economic presence, I would say, even though the significant economic presence did not make reference to the DTT, where a company is providing services or any revenue from Nigeria, the provisions of the DTT would be the reference point, and not the significant economic presence rule. So I would say those are some of the challenges. I can see the FRS or the government trying to, address some of those in the finance bill. But it would have been nice if all these things are coming together so that taxpayers can have clarity as to how they will be taxed and where payment will be made. And then if you look at what is obtainable now for non-resident companies, they are usually taxed based on a deemed rate of 6%. There was a time, I think in 2016, where the FRS said that non-resident companies should file returns, submit financial statements, and all of that. And later on, companies reverted to the deemed rate. So the method in which you would file your returns and really calculate the income that is attributable to Nigerian operations on digital transaction still remains unclear. So those are areas that needs to be clarified and gaps that needs to be closed for us to really, get the maximum benefit from the order. Thanks.
Thank you so much, Yemi. I'm going to go back to Sabonbola. There's something Yemi just mentioned, which is he did mention how this affects or the relationship it has with the DTTs and maybe other laws. And the question I have for Mr. Bonbola is, I want to find out whether you think the SCP order in any way contradicts the provisions of some of these acts, like the DTT that Yemi mentioned. And we also have the NEBSA Act that we have in Nigeria, which sort of exempts certain companies that operate within the free zone authority from paying taxes in Nigeria. So I'd like to find out from you whether you think the SCP order contradicts some of this.
Yeah, thanks very much for that. Maybe let me start by answering your questions and say there are no contradictions. The SCP order is actually a complement to the existing tax laws. So I do not see contradictions. Now, let's look at the specific issues that the SCP order is meant to resolve. It's meant to address the taxation of entities that remotely provide services into Nigeria. And those services, as mentioned in the order, will include the management services, consultancy services, training, software, and all of that people can do remotely. That order is not addressing the whole issue of digitalization. We must be clear with that. I have had the questions about the question about how does it affect entities in the free trade zones. I think if we take our mind back, the concept of free trade zone was to encourage establishment of entities that will manufacture products for export. They are not meant to sell into the Nigerian customs area. They are meant to manufacture and export, and that is why they had granted tax immunity to say we assume that you are not in Nigeria, and which was why there is a specific authority established to manage to grant approval for entities. Howbeit, we have observed that in recent times that the entities in that enclave have begun to market or sell their products into Nigeria. And there are discussions already going on whether that is exactly what was intended. Now, but again, the free trade zones are also not meant to be providing services. They are meant to be producing goods. Either they are manufacturing or they are assembling or whatever. That is actually the original concept. But we are aware that some services providing entities have migrated therein again, and this is already distorting the old concept of the free trade zone. I am hoping that in not too long a time we'll be able to come to a decision. Government will be able to come to a decision as to how to look at that concept all over again. I'm aware that there are suggestions that there may be changes to the law, setting up those entities as regards issues of taxation. So now coming back to answer your question again, now to summarize, is to say that I do not see conflicts between the SCP. You will recall that that Section 13 specifically mandated the minister to come out with an order. So Section 13 of CETA. So it is meant to clarify the law and to establish the framework for its operation, and not in any way to contradict whatever is there. But if there are specific concerns that people have noticed, they will also do well by pointing our attention to those ones, and then we are able to address them. Now, on the suggestion that that foreign companies have resorted to filing returns based on deemed profit, I'm not aware that this is a policy of the government or the FOREX. The policy of the FOREX is based on the law strictly, and the law in Section 55 mandates all companies, and which does not exclude non-resident company, to file returns. Section 30 of CETA enables the FOREX, if the conditions pronounced in that sections are met, to assess a company to tax based on its turnover. And again, this is not limited to non-resident companies, including Nigerian entities. All taxpayers under CETA come under such section if the relevant conditions, the 3 conditions specified in that law, are met. And so if there are entities that are not obeying, complying with what we have in Section 55, I can tell you that they have set themselves off a big time for penalties. Thank you.
So much, Mr. Gwendbola. I'm going to go to Michael Ango now. And one is to maybe also give us his comment on what Mr. Bonjbala just mentioned. Then the second question I have for you is to find out what difficulties you think that the SCP order, presents for foreign businesses operating in Nigeria when compared to their business operation in other jurisdictions. I think Yemi did mention the issue on double taxation and all that.
Sure, thank you very much. So I think I'll just make a few comments on some of the issues that Mr. Bonjbala has raised. The first, I think, was the issue of the free trade zone areas and the operation of or provision of services. So he made the point that at the time these laws were passed enacted, it wasn't in contemplation that there will be provision of services. It was really about goods made for export, had physical products, as it were. So I think for me, the truth is that, again, legislation has to move with time. And if digital services, I mean, the latest GDP figures show, I think that there are maybe basically two areas of the economy that saw significant growth, and I think one was the ICT sector, and I think financial services. So the reality is that the provision of services is also a global phenomenon, and I do not think that we can have a law that then excludes an entire significant sector of the Nigerian economy. My own personal perspective with respect to the citing of, or provision of services from within the free trade zone is that, yes, you can have, some regulations that say as long as your services are export oriented. However, there are very practicable or practical difficulties. And I'll give an example. So if I provide cloud services, as it were, okay, the cloud is not a physical place. And so if I provide cloud services to Nigerian companies, the question then is, am I providing those services into the customs territory? Or is it enough that persons from the customs territory enjoy my services? Another example is if I'm a payment gateway, a Paystack or a Flutterwave, and I provide, payment services platforms for people within the customs territory. But let's even assume focused solely on payments outside the customs territory. So people use my services to make payments into other jurisdictions. Will I then be seen, or will I be deemed to be providing services into the customs territory? For me, I think that these are issues that FIRS will need to sit down and address. But in doing that, let me also say that one of the major issues that I see in terms of the overall implementation of the SCP rules, as it were, is the issue of consultation. And I've made this point at every forum or fora where I've had the opportunity to, which is that I think, it's all good and fine to issue rules and say, look, because these rules are in place, they must be, complied with. But the reality is that there are certain sectors of the economy that are not as straightforward as others. And so compliance will usually require not just consultation, but also cooperation of the industry practitioners. And I think if there's anything, there's a major criticism of the way we've set out our SCP rules and also the way I think we want to implement them, it is the fact that we haven't really sat with the industry operators, the persons who actually are doing the businesses, to understand what is the best way or best approach to get the business in. So I looked at for example, the French digital services tax is 2%. You look at the one in Malaysia and India. I mean, those are very clear. For us, we said once you have the threshold of 25 million and you do ABC and all of that. So the question is, am I, as a a digital service provider, am I to file tax returns in Nigeria based on my actual income? So when I say actual income, I mean all Nigerian sourced income. Mr. Bonjbala said that it's not a policy of the FIRS or it's not law to file on deemed income basis, but we know that over the years that has been the practice. Foreign companies file on deemed income basis. However, there's nothing wrong with asking them to file, on actual profits and all of that. The next question I then have is what happens to things like expenses, things like capital allowances? Does FIRS have a mechanism for verifying all of this? If a foreign company is providing services into Nigeria and it says it has a dedicated building or it has dedicated equipment in in Malaysia and Guatemala, in Costa Rica? How does the FIRS begin to verify, the expenses that it claims it has incurred in providing services into Nigeria? I mean, so these are practical examples, and I think it was Yemi also who said, does the FIRS actually have does it have the capacity to actually do all of those things? And so for me, the major challenge I see is really about how to manage the cross-jurisdictional nature of the services. There's several issues that are involved. It's not just about Nigeria or providing services into Nigeria. So I have a client, for example, who has laid, an undersea cable all the way from Portugal, which passes about 3 or 4 jurisdictions or more coming into Nigeria. So if you use, the bandwidth that particular company provides, who will tax what? Does Portugal have a right to tax some of it? Does the other European countries through which the underground cable pass, do they have the right to tax some of that income flowing into Nigeria? So there are clear issues with profit allocation and all of that. So for me, I think the major issue or the major comments or advice as well, recommendation will really be that there needs to be more industry consultation. People need to understand how these rules will impact them, and then they need to be given an opportunity to also advise and suggest or recommend means by which we can effectively tax those services. I mean, there's no doubt that we should take our own fair share of profits that companies make from providing services into Nigeria, but we must do it in a manner that enables us to also ensure that because at the end of the day, it makes no sense to make a rule or pass a law that is not effectively implemented, and then people will then get away with all sorts of things. So these are my major comments and all of that. But I'm sure that when the finance bill gets to Parliament, we'll have an opportunity. That's the 2021 bill. We'll have an opportunity to comment on it, and we hope that, again, when these comments are made, they'll be taken into consideration in the final output that gets passed into law.
Thank you so much, Michael, for that. I'm going to go back to Yemi. And my question to Yemi, Michael, you mentioned some issues, you raised some issues, and Yemi also raised some other issues that companies may be facing. But beyond companies, my own concern, and the question I have for Yemi is that, do you think that we may attract some retaliatory action from some governments, like the US, for instance? We know what happened between the US and France when France wanted to impose digital tax on some US companies, and Donald Trump just basically announced some huge tariff on French goods, and France had to, submit that. Now, do you think that that is something that we too should be mindful of, or the government ought to be mindful of with respect to implementing the SCP order?
Yeah, thanks, Chiwendu. I mean, one of the principles of international taxation is reciprocity. I mean, if you are taxing companies, operating in a particular jurisdiction, and you have your own companies, providing or earning revenue in that other contracting jurisdiction, I mean, you expect some tax rules to be applied. So if Nigeria goes by the way of significant economic presence to tax US companies, for instance, I mean, it's obvious you would expect some reaction from the United States. And if you want to judge the way a man will react, I mean, you can look at his past and see how he has reacted to similar issues. I mean, you said it yourself that when France decided to impose digital tax to US companies for their revenue in France, I mean, the United States imposed huge tariffs. All right, and there's a United States trade representative that actually investigates companies that impose digital tax on United States companies. So, I mean, there has been investigation on India, in which the United States and India had to come to a compromise on how to tax United States companies in India. So, apart from the fact that there will first and foremost be an economic reaction from the companies themselves, they can look at Nigeria and ask themselves that, am I still going to be making profit if I'm going to be paying this amount of tax? and they may want to shift their operations to other favorable jurisdictions. So first and foremost, the companies themselves may react. And then, I mean, it's clear, it's almost certain that the United States governments themselves will react if they consider such taxes significant enough for those companies operating in Nigeria. I don't know if that answers your question, Chiwendu.
Okay, Chiwendu. Chiwendu is having some slight challenge. Okay, Yemi, thanks for your comments. I think we're almost about to wind up. So let me do the channels TV approach now. You know, I'll give each of the panelists 20 seconds to give their concluding remarks. So let me start from Mr. Bonjubola. Just give us your closing remarks, just an overview of whether it's the CBN manual or the SCP, and then just give us something to look forward to. So what do you think is really the outlook for FIRS and or rather government regulation, as it were, in respect of these two things? What should we be looking at, both from the industry perspective and also from professional advisors? What are the points that people should be worried about, and what message can we carry back to our clients, as it were, in this regard?
Yeah, so thanks very much, Mike, and thanks for the various comments, particularly from Mr. Adeyemi. But please let me just correct one impression from what Adeyemi had said. When you're talking about reactions from the businesses that they may pull out their businesses from Nigeria, we must be careful that we do not misinterpret what we have on ground. The SCP is not related to entities that are physically present in Nigeria. They are related to entities that are remotely dealing with Nigerians, the people that are providing remote services. So don't let us create a panicky atmosphere. It doesn't work that way. If Google stopped beaming to Nigeria, I don't know what business we have lost. Yes, you can say, oh, but the ease of us being able to download this and that, we'll have lost that maybe, but maybe not. But don't forget that Kenya, I think last month, had a significant change to their law, whereby they can even pull down any website that failed to comply with their tax law. And that's talking about those who are not physically in their country. So I just want to clarify that. Now, as to closing thoughts, I think looking at the CBN circulars and the fallout and the issues that have been raised, I think my thought will be that the relevant agencies will work together more. I can say that we are already having that, particularly FRS and CBN, we are collaborating a lot, but we need to do more. I mean, that is one thing, because if this circular is raising this much dust in the industry, particularly having some tax implications, that it's important that we talk to each other more. With respect to the SCP, we are already providing opportunities for non-resident entities to have simplified registration for tax purposes. We are already creating opportunities for them to appoint agents, and also for FRS to appoint agents. So all of this legal framework are already worked out to make life easy for everyone. For non-resident entities that are in Nigeria, my advice would be, please comply with the law. It doesn't matter how stupid the law is, until we have changed it, it remains the law. And so if there are aspects of our law that we need to amend, and I believe and I agree that there are so many other aspects in the law that we need to look at again, yes, let's look at those laws, let's amend them. But as long as we have not amended the laws, they are meant to be complied with. I think finally, let me say that Nigeria is in a very difficult situation. The whole entire budget of Nigeria, of about 150 to 200 million population, is what Kenya, that has about 30 million population, has. So when people say Nigeria is rich, I beg to understand where they got their notion that Nigeria is rich from. because by the time you spread the budget for 2021, if we agree to share to everybody, I'm not sure anybody can get more than 50,000 naira for the whole year. So the only way then we can help is, number one, to ensure that we fulfill our civic duties, we pay our taxes correctly, we comply voluntarily with the laws, and if there are issues that we need to change, let's come up with those issues and let's go ahead and make changes. Thank you very much, Anderson Tax, for inviting me. God bless you.
All right, thank you very much, Mr. Bonjibola. You know, I'm a lawyer, so let me defend my client, Adeyemi. I think when he made the comment about businesses pulling out, I think it's not so much pulling out in the sense that they will not do business with Nigeria, but I think the worry is that those companies may then, you know, begin to put additional requirements for dealing with Nigeria. So, for example, we know that based on a report that was issued, I think in June 2020, Netflix has about 50,000 subscribers in Nigeria. And one of the concerns that some commentators have expressed is that Netflix may then say, look, you know, you cannot subscribe directly from Nigeria in order to avoid, you know, creating a significant economic presence. And then they will put that you can only, you know, probably, you know, subscribe through another channel or platform, maybe from Kenya or from somewhere, that has a more favorable, tax environment, as it were. So these are some of the worries. But of course, you know, we're all Nigerians, we're patriotic, we want Nigerian government to be able to tax and ensure that there is tax revenue to provide, you know, all the things that we need to finance our budget and all of that. But thank you very much. Your comments are well appreciated. Abimbola, you have 20 seconds too. You know, Mr. Bonjibola is my Oga, so I allowed him to exceed his 20 seconds. You are not my Oga, so you better keep to your 20 seconds.
Thank you, Michael Angle. So speaking about the CBN directive, I'm hoping that the banks will liaise with CBN to clarify its expectations instead of going on a wild goose chase of, you know, carrying out independent verification exercises. Just like Josh has mentioned, I think the CBN also needs to revisit the documentation requirements. The existing procedure is already very complex. So, you know, including new requirements in no doubt adds further layer of complexity and delays in concluding transactions. To conclude, I'm hoping that the onboarding process will be efficient if the CBN decides not to back down. I mean, it has to be efficient so that businesses can then run as expected. Thank you. And thanks to Anderson Tax for organizing this session.
Okay, thank you very much. Dr. Josh, any closing remarks, please?
Yeah, thanks, Mike. Quick one. On the CBN side, I think we've done some justice in dissecting the issue. I'm clearly of the view that CBN should make two clear distinctions. First is what they've done, making a distinction between the primary manufacturer and those intermediaries, such as the buying companies or the agents, all right? And clearly, they're giving guidance as to how they're going to deal with those. And there should be some efficiency so that we don't have a lot of bottlenecks, which is going to hurt businesses at a time that we need businesses to do very well. Remember, we are officially in a recession. This is the second recession in a space of almost 5 to 6 years. So anything to really aid businesses to get us out of the recession should be also a priority for an agency that is responsible for the management of the economy. The second distinction, as I said, is the fact that they need to distinguish between transactions with related parties and independent parties, irrespective whether it's a primary manufacturer or an intermediary and buying company or agent, because that is where it's a related party. That's where there could potentially be an incentive for over invoicing and then put undue pressure on the forex demand in Nigeria. That distinction for me is going to be very critical. Now, in terms of the use of the transfer pricing policy to assist with this process, I think it's very imperative that we let people know that this is not new in a jurisdiction such as South Africa. In South Africa, they've always had foreign exchange controls, and the Central Bank of South Africa always requires a TP policy to be provided when a local entity is making payment to its related party offshore, so that they make sure that that payment is not overstated, all right? That expense is not overstated. because the transfer price policy will make sure that it's at arm's length and it's fair and reasonable. So we can actually take you from the South African Central Bank, and make sure that this implementation works well and makes sense, by making a distinction between related party transactions and independent parties. On the SEP side, I think some of the challenges that some of my colleagues have brought up will hopefully be addressed, should OECD come up with Pillar 1, because if you think about the approach that the OECD is looking at, it's going to be a consolidated, P&L approach, where they look at the consolidation and then determine the taxable profit, and then they'll make some deductions for some contributions such as distribution and marketing, and that residual is what will be allocated to the various jurisdictions where they've had some economic activities and some value contribution, based on a reasonable threshold that will be agreed across the countries, so that maybe it might end up that Nigeria's threshold is clearly too low, so the threshold that we agreed could be a bit high. So some of these issues, I believe, will be addressed once we have Pillar 1 in place, so that it doesn't hurt businesses and therefore leads to business continuity. So those would be my comments on those two issues. Thanks.
All right, thank you very much, Josh. Just to say that, please, for participants who have asked questions, what we tried to do was to take the questions, in summary. And so you may find that some of your specific questions might have not been answered in the way in which you crafted them. What we try to do is take the broad issues or topics and respond to them. But what we will then do is we'll answer the specific questions, and then we'll put that out, on our site, our social media platforms, and then of course the Anderson website. So you can go there and you will get the answers to your questions. So you're actually getting free advice without paying. That's a lot for a consultant to do, but what can we do? Chinwendu is back, so I'll just say that for me, I like the fact that we're discussing these issues. I believe that as long as government is open to having conversations with the industry, with tax advisors, it means that at least when you keep the conversation alive, then you are on the path to finding solutions. I know that Mr. Bonjubala is someone who's highly experienced, but more importantly, he's also very accessible. And so my only request would be that the FIRS should continue to keep an open door and also an open mind. I know it's sometimes when you have put out a legislation, you then feel that, look, why should I undo it? But I think there's nothing wrong if commentators, if practitioners all say that they have a challenge with implementing something, then there's nothing wrong with taking a second look at that. Happily, it seems we have sustained this practice of having the Finance Act annually. So we are hoping that what will then happen is that annually these things will be looked at and time corrections. So I'll hand over back to Chinwendu. It's your show. Run it. Chinwendu. Okay, Yemi, do you want to close out? Yeah.
Okay, yeah. So in terms of final thoughts, I think Dr. Josh had said a lot about we aligning our laws to global best practice. So as conversations around taxing the digital economy evolves rather, I believe Nigeria will continue to update its laws, to align with what is acceptable globally. And I think with the annual implementation of the Finance Act, I mean, that helps again to review the laws in the previous year to know areas that amendments should be made, So the taxation of digital economy has come to stay. It's not going to go away. Nigeria has taken the right step, to, begin to look at it, especially the fact that if you look at our tax to GDP ratio, it's still 6%, and we have a lot of deficit in infrastructure provisions, all right? So the federal government really needs money, and I mean, there's nothing wrong in taxing any income that is derived from your jurisdiction. So my closing thought is to say that as events begin to unfold globally, the that Nigeria will continue to make amendments to ensure that the digital economy is taxed effectively and efficiently within the capacity that the tax authorities have. And we can only be better for it. Thanks.
All right, we've exceeded our time by about 10 minutes. So let me thank everyone that has attended. Thank you for your time. Let me thank the panelists, for taking out their time from their busy schedules to come and attend to us. We thank you all. Let's keep the conversation going. If there are any questions or inquiries, please feel free to submit them to us. As much as possible, we'll respond to them. If you need, of course, professional advice, specific professional advice, feel free to contact us. Mr. Bonjubala, thank you, and we look forward to interacting. Thank you all for attending. Have a lovely day and a lovely rest of the month and rest of the year. Stay safe. Thank you, and God bless you all.
Thank you.
Yeah, thank you so much.